This is Jody Trana with Chapter 12, Part 3 of Business Finance. Today's class is really a review of what we've learned in Chapter 12. It culminates in the in-class activity Tradewinds Corporation, which covers a project that is a little more involved than the ones we've worked on before. The first question you ask yourself is, what is the initial cash outlay? Remember that this can include some installation. It could also include training, and that would give you the total capital expenditures. That's a depreciable number there. You also could be adding some net working capital needs for year 0. This might be for inventory or just some additional working capital that you need to start this project. This would total your initial cash outlay. The second step is to ask yourself, what is the annual depreciation associated with this project? Remember that your capital expenditures number could have installation and training in it. You would divide that by the number of years that you expect this project to be active. Here's the step that's a little bit more complicated. We are having to calculate the working capital that we're needing each year. They told us that the working capital needs were 14% of sales. So we have to figure out what our sales is. We start with the sales price, and you'll notice here that the sale price stays the same until year 5 when we reduce the price in order to liquidate everything. Our units sold is a varying amount, starting with 6,000 in year 1, going all the way up to 125,000 for years 2 and 3, and then back down to 60,000 by the time we get to year 5. This means that our total sales predicted will be different for every year except years 2 and 3. Since we need 14% of our sales in working capital all the time, we can identify the balance in working capital that we need by taking our total sales and multiplying it times 14%. We show these numbers as negatives to indicate that those are needs that we have. This particular project has a working capital need in year 0 for inventory of 220,000. Year 1, we have a total working capital needs of 2,436,000. That number again comes from 17.4 million in sales multiplied times 14%. Now remember that we already were able to gather 220,000 of working capital in year 0. So the change in working capital is what's important here. We do need 2,436,000, but since we already have 220,000, our change in working capital for year 1 is just 2,216,000. Now let's take a look at year 2. Our year 2 total working capital needs are 5,075,000. That comes from taking 14% of total sales of 36,250,000. We do need $5,075,000 in working capital, but you can see from the year before we had 2,436,000 already accumulated. So our change in working capital is what is important here. What number will it take to get us from 2,436,000 to 5,075,000? The change in working capital is 2,639,000. Year 3 is an easy one. Because our sales haven't changed, 14% of that is needed in working capital, and that doesn't change either. Because we've already included $5,075,000 into our working capital at the end of year 2, we do not need any additional working capital for year 3. Year 4, our working capital needs, you can see, are decreasing. That's because our sales are decreasing. Sales are only $20 million in year 3. 14% of that means that we need $2,842,000. We've already set aside $5,075,000. So now our change in working capital is a positive number. We're no longer growing our working capital. We're now recuperating our working capital. And finally, in year 5, our total working capital needs are 0. That's because we're not calculating it as 14%. We're shutting down the project. And we know that we need no more working capital because the project's shutting down. In that case, we can recuperate the full $2,842,000 in working capital. It's our change in working capital that is going to be the important numbers in calculating our free cash flow. We're going to ask ourselves 3 questions in order to evaluate this as a project. The first question is, what is our net present value? To calculate net present value, we calculate the present value of our future cash flows discounted back to today at 12%. That would be our years 1 through 5 cash flows. And then we will compare them to our initial cash outlay, subtracting the costs it takes to start this project. We're looking for a positive net present value. Next, we will ask ourselves, what is our profitability index? Profitability index takes the present value of future cash flows, that's our year 1 through year 5 present value discounted back at 12%, and divides it by a positive value of our initial cash outlay of $15,030,000. This is a similar comparison as we did in the previous slide where we calculated the net present value, but this will give us a ratio. We're looking for a number that is 1 or greater. That will tell us that our present value of future cash flows are greater than our initial investment. Our final question is, what is the internal rate of return? When we calculate this rate, we want it to be greater than our required rate of return. The internal rate of return in Excel is just an equation that references all of the cash flow numbers included. We want to include all of them from year 0, our initial cash outlay, all the way through the end of the project. Then Excel will calculate our internal rate of return. That is the rate that it would take in order for our initial cash outlay to be the exact same as the present value of our future cash flows. Or another way to say it is, it tells us the rate of interest that it would take to get a 0 net present value. These are the 3 questions that we ask ourselves to evaluate a project. Positive net present value gives us a dollar number. The profitability index compares the exact same 2 numbers, so it gives us a ratio which may be valuable in comparing it to other projects. If we have a positive net present value, then our profitability index will be greater than 1. The third question we want to ask ourselves is the internal rate of return greater than our required rate of return?